A staggering new statistic this morning from Consumer New Zealand found that, get this, 3 out of 5 homeowners would not be able to afford their home at its current value. Let that sink in.
Auckland's housing market has crashed 23% from peak. Prices are down from roughly $1.29 million in January 2022 to $990,000 now. That's a massive correction, the kind of decline that should fundamentally change affordability. And yet, Auckland is still classified as severely unaffordable. The Demographia affordability rating dropped from 11.2 times median household income down to 7.7 times. That sounds like progress until you realise the threshold for actual affordability is 3 times or less. We've gone from catastrophically unaffordable to just severely unaffordable. The average Auckland family would still need to dedicate 7.7 years of their entire household income, every dollar they earn before tax, to buy the median home. Here's what makes this particularly frustrating. We've had the biggest property crash in New Zealand's modern history. Real values are down 31.3% from peak when you adjust for inflation. Homeowners have lost $192 billion in equity across Auckland. The pain has been enormous. And for what? Housing is still out of reach for most people trying to get into the market. I pulled the latest data from December 2025, and the numbers are stark. Incomes rose 5.5% over the past year. Housing costs, rent and mortgages combined, rose 9%. So even as prices fell, the gap between what people earn and what housing costs has actually widened for many households. Nearly 35% of Auckland homeowners now say their income isn't enough to meet everyday needs. That's up from 31.5% just 2 years ago. So what's going on here? How can prices crash this hard and affordability barely improve? The answer reveals something fundamental about Auckland's housing market that most people miss. It's not just about house prices. It's about the relationship between prices and incomes. And that relationship is still broken even after a 23% correction. If you own property in Auckland and you're wondering why the market still feels tight despite falling prices, or if you're trying to buy and frustrated that a massive crash hasn't opened the door, this is the video you need to watch. Because the affordability paradox, prices crashing yet housing remaining unaffordable, tells us everything about where Auckland's market is really headed and what it would actually take to restore genuine affordability. In this video, we're breaking down Auckland's affordability paradox from 3 angles. First, the numbers. Exactly what 7.7 times income means, how we got here, and why a 23% crash wasn't enough. Second, the income gap problem that nobody's talking about, why wages haven't kept pace with even reduced housing costs. And third, what it would actually take to restore real affordability and whether that's even possible without another devastating crash. Let's get into it. So what does 7.7 times income actually mean in real life? The affordability threshold globally is 3.0 times income or less. That's considered genuinely affordable. Between 3.1 and 5.0, you're in moderately to seriously unaffordable territory. Anything above 5.1 is severely unaffordable. Auckland at 7.7 is deep into that severe category, more than double the affordability target. Here's the reality. Median Auckland household income, roughly $130,000. Median house price, $990,000. That's 7.7 years of every dollar that family earns before tax, before food, before anything. Not 7.7 years of savings. 7.7 years of their entire household income. With a mortgage, the math gets brutal. $990,000 home, 20% deposit, borrowing $792,000 at 5.4% interest. Monthly payment, $5,100. On $130,000 income, that's 47% of gross monthly income just on the mortgage. After tax, it's over 60% of take-home pay going to housing. At peak in January 2022, Auckland was at 11.2 times income. Now it's 7.7. That's 31% improvement, but we're still more than double where we need to be for genuine affordability. Here's why a 23% price crash didn't translate to genuine affordability. Interest rates doubled. Incomes rose 5.5% over the past year. Housing costs rose 9%. Even as prices fell, the cost of servicing a mortgage climbed faster than wages. In 2021, mortgage rates were 2.5% to 3%. Today, even after Reserve Bank cuts, the average is 5.4%, nearly double. So you're buying a house that's $300,000 cheaper, but borrowing at rates twice as high. Here's the math. January 2022, $1.29 million home, 20% deposit, mortgage of $1.032 million at 2.5%. Monthly payment, $4,100. Today, $990,000 home, 20% deposit, mortgage of $792,000 at 5.4%. Monthly payment, $5,100. You're paying $1,000 more per month on a house that costs $300,000 less. That's the trap. Plus, everything else got more expensive. Food, fuel, insurance, utilities. Households now spend $22.20 per $100 of income on housing, up from $20.80 in 2019. And 38% of households say their income is only just enough or not enough for everyday needs, up from 34% in 2021. First home buyers are entering at record levels, 28% of the market, but they're stretching to the absolute limit. Average weekly mortgage payment, $658, up from $605 a year ago. They're getting in, but barely. Let's be clear about who's still priced out. Anyone earning below median household income is effectively locked out. If the median household at $130,000 is stretched at 7.7 times income, anyone at $100,000 or less is looking at 10 plus times income. That's decades of saving or settling for properties well below median. Single-income households have it worse. Someone earning Auckland's median individual income of $70,000 to $80,000 faces a 12 to 14 times income multiple. Even post-crash, it's out of reach without family help. Banks are stricter now. Debt-to-income restrictions cap borrowing at 6 to 7 times income. So even with a deposit saved, your borrowing capacity limits what you can buy. Employment uncertainty makes it harder. Unemployment rising, GDP down 0.9%, weak labor market. Banks know this, and they're cautious about lending. You might qualify today, but will you have a job in 6 months? Here's the reality. 14.8% of homeowners are spending 40% or more of gross income on housing. That's the threshold where housing cost becomes severe. One unexpected expense, medical bill, car breakdown, job loss, and you're in crisis. For renters trying to save, Auckland rents average $631 per week. On median household income of $130,000 after tax, that leaves limited room to save. To get a 20% deposit on $990,000, you need $198,000. At $800 per week savings rate, which is aggressive, that's nearly 5 years. And that assumes nothing changes. So what would genuine affordability look like? And can we get there? To hit the 3.0 price-to-income threshold, actually affordable, Auckland needs prices at $390,000 to $420,000. We're at $990,000. That's another 60% crash from here. Not happening. That would trigger economic collapse, bank failures, mass foreclosures. Alternative: if prices stay at $990,000, incomes need to hit $330,000, a 154% increase. Also not realistic. At 5% annual wage growth, that takes 20 plus years. Prices won't stay flat for 2 decades. The realistic goal? Get to moderately unaffordable, 4.0 times income. That needs either prices falling 34% to $650,000 or incomes rising 93% to $250,000, some combination of both over many years. But here's the problem. Economists forecast 3 to 5% price growth in 2026. If that happens with 5% income growth, the ratio gets worse. We move away from affordability, the only path to improvement, flat or falling prices while wages grow steadily. That's a narrow path requiring years of grinding sideways conditions. Building more supply could help. Auckland built 18,000 homes last year, but construction has crashed, building consents at 6-year lows. Developers won't build without buyers. It's a chicken and egg problem. The brutal truth, Auckland is stuck in severely unaffordable territory for years, likely a decade or more. The 23% crash wasn't deep enough. We've gone from catastrophic to severe, and that's probably as good as it gets without either a depression-level crash or a generation of flat prices while incomes catch up. Auckland crashed 23% from peak, with prices falling from $1.29 million to $990,000. The demographia affordability ratio improved from 11.2 times income to 7.7 times. That's a 31% improvement in the ratio. Sounds significant until you realize the affordability threshold is 3 times or less. At 7.7 times, Auckland remains classified as severely unaffordable, more than double the target. The core problem is incomes haven't kept pace with housing costs. Wages rose 5.5%, while housing costs rose 9%. Mortgage rates doubled from the 2021 lows, which means monthly payments on a cheaper house are barely lower, or even higher in some cases, than at peak. Nearly 35% of homeowners say their income isn't enough for everyday needs, up from 31.5% 2 years ago. The affordability paradox is this. The crash was devastating for homeowners who lost equity, but not deep enough to restore genuine opportunity for buyers. We've moved from impossible to just really, really hard. And unless something changes dramatically, deeper crash, explosive wage growth, massive supply increase, Auckland is stuck in severely unaffordable territory for the foreseeable future. If this breakdown helped you understand why Auckland remains out of reach despite the crash, hit like and subscribe button and make that bell scream. We're tracking affordability and market dynamics as they evolve. Drop a comment if you're trying to buy in Auckland, share your experience. And if you found this valuable, share it with others who need to understand the reality behind the numbers. Auckland's 23% crash changed the market, but it didn't fix affordability. The gap between prices and incomes is still too wide, and closing it will take years. Thanks for watching. I'll see you in the next report.